Okay, starting with the exercise set. Our first exercise here says we work for Hilton Hotels and Resorts. In the accounting department, we have to set up a responsibility accounting structure. And our supervisor asks us to give an example of a cost center, a profit center, and an investment center within Hilton. You're probably familiar with Hilton. It's a famous brand of hotels. They have many other, sub-brands under the Hilton name. But just think about hotels in general. In a hotel, especially a, large hotel chain, what would be an example of a department that would be a cost center in a hotel?
Maintenance.
Okay, maintenance. That would be a good example. So under cost center, we'll put maintenance. What else? What's a department that would have costs but really wouldn't generate revenue? Other than maintenance.
Or like the services like TV and electricity problem.
Well, there would be costs, but what department would that be?
HR.
Okay, human resources, yeah. Department. Maybe Ivan facilities. Might have a facilities department that would maintain. Well, that's maintenance. There could be a difference between facilities and maintenance. So maybe housekeeping, right? That'd be a cost center. They don't generate revenue. Okay, so we've got a couple examples. Then profit center. Think about in a hotel, what might be a department that actually can generate revenue? Booking, okay. That's true. So they could be a profit center. They might just be considered a revenue center, but they could also be, since they do have some costs, be a profit center. Oops, look, did I write? Profit hotel, okay. Okay, is it Friday yet? Profit center, I meant to write booking, okay. Okay, that would be one example. What else?
A bar, cafe, and lobby.
Okay, a bar or cafe. What did you say, Elby?
Room service.
Room service, yeah, okay. So we could have a bar, cafe, room service. I like how I put the little accent on the E in cafe. Wow, that was fancy. A restaurant, right? Those all generate revenue, but also have significant costs. So those could be treated as profit centers. Maybe a spa. Some big hotels have a spa. All right, and what about an investment center though? Might an individual hotel or a region of hotels be given the option to invest some company assets and expand their services, their facilities? So possibly. So we could say, an individual hotel. So it wouldn't be a particular department within the hotel, it would be a hotel in total, or what's even more likely would be a region. Within the chain. So for example, you might have somebody who's in charge of the Western region, and they're given a certain amount of assets they can use to invest and expand, open up new hotels, add restaurants to some of the hotels.
would hotel making or building a swimming pool to attract clients would be considered an investment?
Probably, right? Because there'd be a lot of cost that goes into building that hotel. I mean, that pool. Sorry. I think my brain's getting a little tired here. There would be a cost to building that pool. So that money has to come from somewhere. Now, if it's something where they would ask corporate and corporate gets to decide, oh, we're going to give you that money, well, then it was really corporate's decision, right? But if the general manager can decide on their own, hey, I'm going to take some of my profits and invest it into making a swimming pool. If they have that authority to make those investments, then you'd want to hold them accountable for those investments. Okay, so I think that gives us an idea. Any questions here on this first exercise? Right. Number 2, consider the American Red Cross, which I'm sure you're familiar with. They do a lot of good work. God bless you.
Thank you.
Yes, sir.
The first exercise is we also have to explain the difference between profit center and an investment center.
Okay. I'd like you to explain the difference. Okay. So I didn't write it down, but I think you get it, right? An investment center can invest assets of the company, and a profit center cannot. Good point. Good attention to detail there. All right, so for number 2, American Red Cross, you're probably familiar with them. They're a nonprofit organization. They collect blood donations, but they also go when there's an emergency, help people in need, right? They do a lot of good stuff. And it says here, we're the regional director, so we're responsible for a geographic region. We just got the quarterly financial reports. It says that although we're a nonprofit, our region is set up as a profit center so that we could see how much money we're making or losing. I think you already know a nonprofit can earn a profit, you just can't pay it out to investors. So you have to either just save that money or reinvest it back into the organization. So one particular report shows there's one location that is extremely over budget on nearly every expense item. When could that be a good thing? So let's say the Monterey location of the American Red Cross is way over budget. Their costs were way more than were budgeted. Well, that sounds bad, but what would be a situation where that's actually a good thing?
Because it's a nonprofit, you have money, like extra money that you need to put somewhere.
Okay.
So you just blow it all on expenses.
Okay, but it would be better to use that extra money for growth, right? To provide extra services, which would be then expenses. So yeah, I see what you're saying. Okay.
It might have performed really well and have increased output and maybe donations for the same period in which it had the same expenses.
Donations coming in or donations?
Donations coming in because it's a nonprofit, it doesn't have revenue.
Right. So, but if it has more donations coming in, which is a good thing, but what it's saying here is that their expenses are over budget. So you're saying they got more money in, and so they also had more money going. Okay, well that's
more production going on, more activity.
That's valid. The nonprofit that I'm on the board of, the more money we generate, the more revenue we have, the more we do give out in grants. So yeah, that would be a good point. And another possibility too is if there is a natural disaster, like maybe flooding, right, which is happening pretty frequently lately. Well, then you would want that money to be spent in order to help those people who need it, right? Okay, so the question here, what are the reasons why going over budget might be a good thing? And how might we respond to those overages in a particular location? So the first question, we can say going over budget on expenses is appropriate if the funds are being used to benefit the intended recipients, right? So as a nonprofit, if we're spending more money, but we're actually doing more good in society, that's a good thing. If we're wasting money, obviously that's not a good thing. So as for the second question, how might we respond to these overages to help the particular location? So let's say you're looking at this report and you're saying, wow, the Monterey location, Monterey County location spent a lot of money recently, but there were floods. So should we change the budget? Should we leave it the same? What should we do going forward?
Well, you wouldn't want to tweak it on a natural disaster because it's not gonna there's not gonna always be a flood.
Let's hope.
You tweak it, it will fall short.
Right, exactly. If we think that this is a one-time event, once in 100-year kind of flood, well, then it was just an anomaly, right? On the other hand, if we think the weather patterns are changing enough that we're going to have significant sorts of issues on a regular basis, maybe we should adjust the budget, right? So we could say, evaluate whether the budget should be adjusted due to systemic changes or left as is due to an anomaly. Anomaly. Is that how you spell anomaly? Oh, no, that's how you spell it. Okay. So something like that could be a good explanation. So I'm no meteorologist, but if I owned a home in the area, I think I would get flood insurance. if I were a nonprofit, I think I would be a nonprofit, Red Cross or disaster sort of organization. I think I would be prepared for more extreme weather conditions in the coming years. Based on trends, we've seen the weather patterns get more and more erratic every year. The good news is, looks like our drought's over for a while, right? The reservoirs are filling back up, the snowpack is good, right? It's too bad it all came at one time. Okay, any questions on exercise 2? All right, well, let's go on to number 3. Go. Okay, so we've got these 3 golf courses. We're looking at their July income statement. These are 3 different courses all owned by the same company. We're missing some data, so one thing we'll have to do is fill in the data. And once we've done that, then we can analyze and look at what's going on with these golf courses. Oh, okay. So with the blue course, we're missing their outings revenue. How can we figure out the outings revenue?
Take the total revenue and subtract the green fees revenue.
Okay, that works. Take the total revenue, subtract the greens fees revenue, and the difference must be their outings revenue. So that's $11,000. Revenue. In the black course, we're missing these wages here. How can we figure out the wages? We use the same basic approach. Yeah, Zach says yes, we could take our total expenses, subtract the expenses we know about, and what's left over must be the wages. So that gives us 56,300, I believe. Is that consistent with what others got? The last one here, we need to figure out operating income for the gold course. So how do we figure that out? Okay, so revenue minus the expenses gives us 23,770. Okay, so we have the missing information. Now we need to comment on the financial performance of each course. So, which course had the highest revenue?
Black course.
The black course. Which course had the lowest expenses? The gold course. And which had the highest operating income?
The gold course.
Also the gold course. Even though it didn't have the best revenue, it was the most profitable. That's interesting. They actually had the lowest revenue, but they were the most profitable. Okay, so it says to comment on the financial performance of each course. So we could say the gold course had the lowest revenue, but the highest profits. Right, operating income is profit in this case. The black course had the highest revenue. And what's going on over here with the blue course? They had medium revenue, medium expenses. They had the lowest operating income. Or profit. So looking at the dollar amounts, that's what we see. Any comments? Other observations? So then part C says identify a limitation of analyzing the information provided. So what we did here is we just looked at the dollar amounts and then we were able to compare those dollar amounts. But in what way is that approach to analysis limited? In what way is it not able to show us the full picture of what's going on? Remember how earlier we saw how you see information one way if you look at the dollar amounts, but if you look at percentages, you can kind of see different information.
Their performance is completely relative to their own expenses and revenues.
Exactly, everything's relative. So when you turn it into a percentage, you could see, for example, how were their costs in relation to their sales? How was their profit in relation to sales? Instead of just seeing dollar amounts and then not being able to really see relationships. So I'd say without Without calculating ratios, it is difficult to see relationships between the golf courses and within their what word? Results. Something like that. Okay, we are going to see this same exercise again in the problem set. Same data, but we're going to actually do a little more analysis of it using some percentages and then see what we see that we don't see currently. But I don't think we'll get to that today. Okay. Questions or comments? All right, let's look at number 4. Dave's Sporting Goods. Okay, so we see data for 3 different stores, each in a different state, all part of the same company. Again, we can look at the dollar amounts. We see that Iowa has the highest sales. Nebraska has the lowest cost of goods sold. Iowa has the best gross profit. But despite Iowa having the highest sales and the highest gross profit, they're operating at a loss. Well, what's causing that?
Costs from corporate.
Okay.
It would $15,000 in costs.
Yeah, so imagine you're the general manager of the Iowa store. You're doing great, right? You got high sales, high gross profit, but corporate is allocating $15,000 of costs to your store that you have no control over. And the other stores are getting $5,500 or $3,000. That doesn't seem fair, right? Of course, we don't really know what those costs are from, but it would seem like they should be more in proportion to the size or the profits of the store. Okay, so part A says comment on the operating income results for each store. Well, Nebraska has the highest operating income, but it has the lowest sales. Right? Iowa is the opposite. They have the highest sales, the lowest operating income. Illinois, well, it's kind of in the middle, right? Okay. So it says, assume the costs allocated from corporate are uncontrollable costs for each store. How does that change your assessment of each store? So as we said earlier, it doesn't really seem fair that the Iowa store has such high allocated costs. Imagine those $15,000 of costs went away. Or even if it was reduced down to this $5,500, this would be the most profitable store. So we could say the allocated costs do not seem to be fairly distributed among the stores. If they were, the Iowa store would be the most profitable. Any questions or comments? All right, so we'll move on to the next one here in a second, and this one has to do with transfer pricing. Department A sells all of its output to Department B. Department A has only one customer, and that's Department B. All right, so we see here Department A's sales, 22,000, is part of Department B's cost of goods sold. Now, we need to calculate the income or loss for each department, and we have to turn that into a percentage. And then we have to try to see what's going on here with these departments. Did anybody need more time here on exercise 4? Okay. Okay, so let's go ahead and start by calculating operating income for Department A. How do we figure out operating income?
Profit minus the expenses.
Okay, we take their gross profit, we subtract these expenses, and we get operating income. $2,740. We can do the same thing over here for Department B. Negative 3,920. It's like somebody's not going to get a bonus. The manager of Department B. And then how do we turn that into an operating income percentage?
Divide by sales.
Divide by sales. Okay, so we take our operating income for Department A divided by sales for Department A. And that tells us that their operating income is 12% of their sales. Okay, it already shows percent over here, so I'm just going to enter 12. And same thing for Department B, but of course, this time we're operating at a loss. When you do a calculation starting with the negative number, make sure you clear out your calculator first. So we go negative 3,920 divided by sales. And we get negative 8%. Confirm, oh, wait a minute, that's 8.5. So we say, yeah, 12 and negative 8, okay. So obviously Department B is not doing great. Department A is doing well. But again, it's based on the fact that Department A has $22,000 of sales to Department B. That's where most of Department B's costs are coming from. How do you think the Department B manager feels about this arrangement? Probably not great, right? they'd like to see these costs come down so that they will be more profitable. Well, let's do what's called a vertical analysis. And by doing that, it's going to give us a better idea of what's going on, where these costs are coming from. And the way we do the vertical analysis, we take each number and divide it by sales. So we'll take Department A's cost of goods sold divided by Department A's sales. We get 48%. And we continue on utility expenses divided by sales. That's, we'll call that probably 5%. Let's see if they round it off. Yeah, they rounded it to 5%. Wages comes out to 25%. Costs allocated from corporate, 10%. Okay. So out of $22,000 of sales, 48% of that goes to cost of goods sold, 5% to utilities, 25% wages, 10% cost from corporate. Let's do a similar analysis over here. So cost of goods sold divided by Department B sales. Got 52%. Utilities. Call that 6%. Wages. 20%. And lastly, corporate costs come out to 29%. Okay. Well, now that we've done this analysis, you notice anything interesting? You know, it's all fascinating, I know, but anything stand out? Anything like flashing red? We do see that there's a high wage expense in Department A, right? Maybe if they could get those wage costs down, maybe they could lower their sales price. Also interesting that Department B's costs from corporate are 29% of their sales, whereas for Department A, it's only 10%. That doesn't seem fair.
It's kind of like what we saw the other place.
Yeah, exactly. Yeah. So those might be some things looking into. So if we go down to this next section here, Department B had an operating loss, right? Losing money, which was driven by a higher cost of goods sold. Department A also has a higher wage percent of sales. And Department B receives a higher percent of allocated costs. We have 3 hires in a row. Is that correct? Yeah, 3 hires in a row. Okay. These factors negatively impacted the financial performance. Kind of feel like I'm doing a Mad Lib. Did you all do Mad Libs in school? Okay, so that's our analysis here of the situation. Any questions or comments? Okay, well, these last couple exercises all relate to that one, so I don't know if we can get through all of them, but let's see what we can cover here. Excuse me. As a manager of Department B, based on the costs you identified, how does this impact the financial performance of your department, and what might be some questions you want to ask or solutions you might want to propose? So we kind of discussed that already. Why are Department A's wages so high? Why is the corporate cost for Department B so high? Can we negotiate a lower transfer price? That would pretty much be it. Those three questions. Okay, number 7 says, we've determined that the market price for the items we buy is 15% below what we're being charged by Department A. I knew it, we're getting ripped off. So how would we view this as a manager? We would feel that we were paying too much, right? What steps could we take to solve this discrepancy? Try to negotiate with Department A. What alternatives would we consider, assuming we had control over purchasing decisions?
5% less.
Yeah. Identify an external supplier with a better price. Oops, negotiate. Okay, let's see what number 8 is. Oh, yeah, maybe we better save number 8. I don't want to rush through it. So great. Wow. We are definitely going to be finishing early on Thursday. I can't tell you how early, but we're definitely not going to need the full time on Thursday. So come back then and we will finish it up. All right. See you all Thursday.